Shopping malls were supposed to be dead. That was the story for years. E-commerce was growing, department stores were struggling, and many investors decided that mall REITs were finished. But then you look at Simon Property Group, ticker SPG, and the story becomes more interesting. Simon is still reporting high occupancy, rising rent, strong retailer sales, growing real estate FFO, and a higher dividend. So maybe the question is not, are malls dead? Maybe the better question is, which malls are still strong enough to survive? In this video, we're going to look at Simon Property Group and ask whether shopping malls are actually making a comeback in 2026. But the answer will not be simple, because the mall is not dead, but the weak mall may be.
The old narrative was easy to understand. Online shopping wins. Physical retail loses. Malls become empty. Stores close. And mall REITs become value traps. That story was not completely wrong. Some malls really did struggle. Some properties lost relevance. Some tenants disappeared. And some retail real estate became much less valuable than investors expected. But the problem with that story is that it treated all malls as the same. A weak mall in a bad location is not the same thing as a premium mall with strong tenants, restaurants, entertainment, luxury demand, and healthy traffic. That distinction matters. So before we say malls are back, we need to define what kind of mall we are talking about. And that brings us to Simon Property Group. Simon Property Group is a real estate investment trust focused on premier shopping, dining, entertainment, outlets, and mixed-use destinations. In simple terms, SPG owns high-quality retail real estate. It leases space to tenants. It collects rent. And because it is a REIT, it distributes a meaningful portion of its cash flow to shareholders. For beginners, the key idea is this. SPG is not just a mall stock. It is a real estate cash flow business. For intermediate investors, the focus should be occupancy, rent, tenant sales, FFO, dividend coverage, and debt. For advanced investors, the real question is whether Simon's premium assets can keep producing enough cash flow to justify the stock's valuation. So, to understand SPG, we need to understand how a mall REIT actually makes money. A mall REIT works through a very direct model: own properties, lease space, collect rent, redevelop assets, and pay dividends. That sounds simple, but every step matters. A mall only works if tenants want to be there. Tenants only want to be there if customers show up and spend money. Rent only grows if the space is valuable, and dividends only stay healthy if cash flow supports them. That is why mall REIT analysis cannot stop at the headline dividend yield. You need to know whether the properties are productive, whether tenants are strong, whether rent is rising, and whether the company can keep investing without damaging the balance sheet. This is why the mall comeback story is not about nostalgia. It is about numbers. A shopping mall comeback does not mean every mall is coming back. That is the most important idea in the entire video. The recovery is selective. Premium malls can still attract strong tenants, high sales, luxury brands, entertainment, restaurants, outlets, and redevelopment opportunities. Weak malls may still face low traffic, store closures, old assets, poor tenant demand, and falling relevance. So when people say malls are back, we need to be careful. Some malls may be back, some may never come back, and some may only survive after major redevelopment. Simon Property Group is interesting because it sits closer to the premium side of that divide. That gives SPG a stronger comeback thesis, but it does not remove the risk. It just makes the question more specific. Premium malls can survive because they are not just places to buy things. The best malls are becoming destinations. Shopping is part of the story, but so are dining, entertainment, luxury, outlets, services, events, and mixed-use experiences. That matters because e-commerce is very good at convenience, but physical retail can still win on experience. A customer can buy something online, but they cannot fully replace a day out, a restaurant visit, a luxury shopping experience, a movie, an event, or a destination outlet trip with a website. That does not mean every mall is safe.
It means the strongest malls have more ways to stay relevant. And if the strongest malls are staying relevant, then SPG's operating metrics should show it. So now we need to look at occupancy. Occupancy is one of the first numbers to watch. In the first quarter of 2026, Simon reported occupancy of 96% for its U.S. malls and premium outlets. That is a strong number. It suggests that tenants still want space in Simon's properties, and for a mall REIT, that matters. Empty space does not pay rent. Weak demand can pressure lease terms, but strong occupancy gives the landlord more room to protect cash flow. Still, occupancy alone is not enough. A mall can be occupied and still have weak economics if rents are flat or falling. So the next question is rent. Are tenants just filling space, or are they willing to pay more for that space? That is where the comeback story becomes more serious. Rent tells us whether the space has pricing power. In the first quarter of 2026, Simon reported base minimum rent of $61.99 per square foot. That was up 5.2% year over year. This is important because a mall comeback is not just about people walking around, it is about tenants being willing to pay for space. If rent is rising while occupancy remains strong, that suggests the properties still have demand. It does not guarantee future returns, but it does make the malls are dead narrative look too simple. For Simon, the rent data supports the idea that premium retail real estate can still matter. But rent growth also depends on tenant health, and tenant health shows up in sales. Tenant sales are one of the most important pieces of the SPG story. Simon reported retailer sales of $819 per square foot for the trailing 12 months ended March 31, 2026. That was up 11.8% year over year. Why does that matter? Because if tenants sell more per square foot, they can usually justify paying rent. Stronger sales can support stronger leasing demand, and stronger tenant productivity can make premium space more valuable. This is where the mall comeback thesis becomes more believable. It is not just that Simon has buildings, it is that the tenants inside those buildings are generating sales. But sales are not the same as foot traffic, and that distinction is worth understanding. A lot of people judge malls by foot traffic. That makes sense, but it is not the full picture. The better question is productivity. Are people spending? Are tenants generating sales? Can stores afford the rent? Is the tenant mix strong? Are restaurants, outlets, entertainment, and luxury brands pulling customers in? A mall with crowds but weak spending may not be as strong as it looks. A premium mall with fewer but higher value customers may still be very profitable. That is why sales per square foot matters. It connects customer behavior to tenant economics, and tenant economics connect directly to rent. But for a REIT investor, rent and tenant sales still need to flow into one key metric, FFO. For REITs, FFO is one of the most important metrics to understand. FFO stands for Funds from Operations. It is commonly used because regular accounting earnings can be less useful for real estate companies. Real estate has depreciation and other accounting items that can make net income look different from the cash flow power of the property portfolio. So when analyzing a REIT like Simon Property Group, investors should not only ask whether net income is up, they should ask whether FFO is healthy. FFO helps support dividends, it helps support redevelopment, it influences valuation, and it gives investors a better sense of whether the real estate is producing. If shopping malls are making a comeback, that comeback should eventually show up in cash flow. Now let's look at Simon's numbers. Simon reported real estate FFO of $3.17 per diluted share in the first quarter of 2026. That was up 7.5% from the prior year. This matters because it gives the comeback story financial support. High occupancy is good. Rising rent is good. Stronger tenant sales are good, but FFO growth is where those operating results start to matter for shareholders. It supports the dividend, it supports balance sheet flexibility, and it supports the argument that Simon is not just surviving the retail shift, it may still be producing meaningful cash flow growth. But investors should be careful here. One strong quarter does not make the stock an automatic buy. It strengthens the thesis. Then we still have to look at dividends, risk, and valuation. Simon also raised its quarterly dividend to $2.25 per share for the second quarter of 2026. That was a 7.1% increase year over year. For REIT investors, dividend growth matters. It can signal management confidence. It can show that cash flow is supporting shareholder payouts. And it can make the stock more attractive for income-focused investors. But a higher dividend does not remove risk. It does not protect the stock from interest rates. It does not guarantee tenant strength forever. And it does not mean valuation no longer matters. The dividend is part of the SPG case, but it is not the entire case. To understand the risk, we need to look beyond the payout and ask what could go wrong. Dividend investors sometimes make one big mistake. They see a dividend and stop thinking. That can be dangerous. With Simon Property Group, the dividend should be analyzed alongside FFO payout, debt, interest rates, tenant sales, occupancy, redevelopment needs, and valuation. A dividend is only as strong as the business behind it. If FFO grows and the balance sheet stays healthy, the dividend story becomes stronger. If tenants weaken, financing gets more expensive, or valuation becomes stretched, the dividend alone will not save the investment. So SPG may be interesting for income investors, but this is not a bond. It is an equity REIT tied to retail real estate, and retail real estate still has real risks. The first risk is simple. Weak malls still struggle. The strongest argument against the mall comeback is that many weak malls still have serious problems. Low traffic, weak tenants, store closures, old properties, debt pressure, and e-commerce competition. Those risks are real, and investors should not ignore them just because Simon's numbers look strong. In fact, Simon may be strong partly because weaker properties are losing relevance. The winners can gain more bargaining power while the weaker assets fade. That is why we should not say the entire mall industry is back. A better statement is this: the comeback may belong to the winners, not the whole industry. And if that is true, Simon's advantage depends on continuing to own the kind of assets that tenants and customers still want. But there is another risk that never disappeared: e-commerce. E-commerce did not disappear. Online shopping is still convenient, price comparison is still easy, and many consumers still prefer to buy certain products online. So premium malls cannot pretend the digital threat is gone. They need to complement digital retail. That means stores become part of an omni-channel system. Shopping, pickup, returns, service, branding, dining, and entertainment can all work together. The best physical locations can support online brands, and online platforms can still benefit from physical presence. But this requires high-quality real estate. Weak locations may not have the traffic, tenant mix, or experience needed to compete. So Simon's challenge is not to bring back the old mall exactly as it was. The challenge is to make premium retail real estate useful in a digital world, and that still depends on capital. Interest rates still matter for Simon Property Group. They matter for every REIT. Higher rates can increase debt costs. They can pressure valuations. They can change cap rates. They can make treasuries more competitive for income investors. And they can make redevelopment projects more expensive. This is important because Simon may have strong properties, but real estate is still a capital-heavy business. A great mall portfolio still needs a disciplined balance sheet. If financing gets too expensive, growth can become harder. If cap rates move against the company, valuation can compress. So even if the mall comeback is real, investors still need to understand the rate environment. The story can be strong, but the cost of capital still decides a lot. And that brings us to liquidity. Balance sheet flexibility matters when real estate markets get difficult. At the end of the first quarter of 2026, Simon reported approximately $8.7 billion of liquidity. That includes cash and available capacity under revolving credit facilities. Why does that matter? Because liquidity gives a REIT options. It can help with refinancing, it can support redevelopment, it can provide downside protection, and it can give management more flexibility when capital markets are not easy. That does not mean debt risk disappears. It does not mean interest rates stop mattering. But it does mean Simon is not analyzing its future from a position of weakness. For investors, this matters because a retail REIT with premium assets and capital access is very different from a weak mall owner with limited flexibility. Now, we can pause and connect the dots. So far, the SPG story is more nuanced than malls are dead or malls are back. The better view is this: premium assets still matter, tenant sales matter, rent matters, FFO matters, debt matters, and valuation matters. That is the kind of no-hype REIT analysis we focus on at Boring Money Wins. If this breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want real analysis instead of noise. Now that we understand the operating story, we need to ask the market question. Is SPG actually attractive as a stock? Because a good company is not always a good buy. Price still matters. This is where many comeback stories become dangerous. A company can have improving numbers and still be a mediocre investment if investors overpay. For SPG, valuation should include price to FFO, dividend yield, growth expectations, NAV discount or premium, treasury spreads, debt risk, and margin of safety. If the market already prices in the comeback, future returns may be limited. If the market is still too pessimistic while the numbers improve, the opportunity may be more attractive. That is why investors should not buy SPG just because the mall death narrative was too extreme. The real question is whether the stock price gives you enough return potential for the risks. The comeback story can be real, but valuation decides whether it becomes a good investment. Quality does not equal automatic buy. Simon may have strong occupancy, rising rent, strong tenant sales, FFO growth, and a higher dividend. Those are positive signs, but the stock still needs to make sense at the price offered by the market. Business quality and stock valuation are related, but they are not the same thing. A high-quality REIT can be too expensive. A struggling REIT can be cheap for a reason. And a comeback stock can already have the comeback priced in. So the investor needs to separate two questions. First, is Simon Property Group still a strong retail real estate business? Second, is SPG stock attractive at today's valuation? Those are different questions, and keeping them separate helps avoid lazy investing. SPG is not the same kind of REIT as Realty Income. That comparison matters. A net lease REIT is usually more about predictable rent streams and long-term lease contracts. An industrial REIT is tied to logistics, warehouses, and supply chains. A strip center REIT may benefit from grocery anchors and everyday retail, but SPG is more directly tied to premium mall and outlet real estate. That gives it a different risk and reward profile. If premium malls keep improving, SPG may benefit. If retail traffic weakens, tenants struggle, or e-commerce pressures physical shopping again, SPG may feel that pressure. So SPG is not just a generic income REIT. It is a retail experience comeback thesis that may be attractive for some investors, but not for everyone. SPG may appeal to investors who believe in the comeback of premium retail real estate. It may also appeal to dividend investors who are comfortable with retail risk. REIT investors may like the scale, property quality, and income profile. And investors who understand cycles may see SPG as a way to invest in high-quality malls, outlets, and retail destinations. But the key phrase is risk-tolerant. SPG is not pure bond-like income. It is not a risk-free dividend machine. It is a REIT tied to physical retail, consumer spending, tenant health, interest rates, and valuation. So it can fit a portfolio when the role is clear. It may be a quality retail real estate position, but it should not be bought only because the dividend looks attractive. That leads to who should be careful. Some investors should be careful with SPG. If you are only chasing yield, you may ignore the retail risk. If you hate exposure to malls, this stock may not fit your temperament. If you do not understand FFO, you may judge the REIT using the wrong numbers. And if you ignore debt and interest rates, you may miss major risk factors. And if you need bond-like safety, SPG is probably the wrong tool. A mall comeback is a thesis, not a guarantee. Even strong properties can face pressure if the economy weakens, tenants struggle, rates stay high, or valuation becomes too expensive. So SPG deserves analysis, not blind optimism. The company's numbers look stronger than the old mall death narrative, but the final verdict still needs balance. So, are shopping malls making a comeback in 2026? The balanced answer is yes, but selectively. Premium malls appear much stronger than the old narrative suggested. Simon Property Group's occupancy, rent growth, tenant sales, real estate FFO, dividend increase, and liquidity all support the idea that high-quality retail real estate is still relevant. But this does not mean every mall is saved. Weak malls can still struggle. E-commerce still matters. Debt and interest rates still matter. And valuation still matters. So SPG may be one of the better ways to invest in the mall comeback thesis, but it is not an automatic buy at any price. The comeback is real only where the numbers support it. And with SPG, the numbers are strong enough to make the debate worth having. The old story said malls were dead. The new story says malls are back, but smart investors should avoid both extremes. The real answer is more boring. Some malls are weak, some malls are still valuable, and the difference shows up in occupancy, rent, tenant sales, FFO, balance sheet strength, and valuation. That is why Simon Property Group is interesting. It gives investors a way to study whether premium retail real estate still deserves a place in a modern portfolio. But the story needs cash flow, not nostalgia, not headlines, not memories of what malls used to be. Cash flow, discipline, valuation, risk awareness. That is how boring money survives, and boring money usually wins when the story is backed by cash flow.